Ladies and gentlemen, welcome to An Independent View with Lobo Tigre. Our guest of the day is Lyn Alden of lynalden.com. Now, Lyn's a new phenomenon in the resource sector space as far as I'm aware. I've been doing this for a while, and it just seems like the last year or two, Lyn is everywhere. And everywhere I see her, she seems to be the voice of reason, one of these people who is not hype and not arm-waving, but just really rational and reasonable and just really cogent. So I wanted to talk to Lyn and get her take on lots of things that are on my mind today. But before we go there, Lyn, you did sort of appear out of nowhere. Who are you?
Yeah, so for people that aren't familiar with my work, my initial background is in engineering, and so I went through electrical engineering, then kind of shifted more towards engineering management, with like a master's in engineering management degree, kind of managing the finances of an engineering facility. And then the kind of the separate track I did was that ever since I was like a kid, really, I've been interested in investing. And so actually I've been investing for, longer than I've been an engineer. And in 2016, I decided to kind of, put some of that together. And so I founded Lyn Alden Investment Strategy that just kind of provides market research for both institutional and retail investors. And my approach, I kind of draw from both sides of that. So in some ways, I use more of an engineering mindset when kind of analyzing different types of investments, as well as the financial background to kind of apply those into the more specific discipline. And so for a few years there, the business was pretty successful, but it wasn't like huge. And really in the past kind of 18 to 24 months, it kind of had a pretty big rise in terms of the following on a couple different platforms. So I think I kind of came on more people's radar in that time period.
So you have been doing this since 2016. That is interesting. Um, you seem awfully young, but I guess if you've been investing since you were a kid, then you have some experience. But in my case, I learned a lot of what I learned from Doug Casey and Rick Roll, and these guys have been my mentors for many years. Did you have experiences like that, or are you just completely self-taught?
Well, I guess I mean my mentors were people that I learned from at a distance, and so there are people whose bodies of work I've certainly learned from, and so for I'm 33, so I've been investing for what has been over 15 years now, and but it's obviously there's people that are far more experienced that I've kind of incorporated some of their ideas into my analysis, and so you mentioned Rick Rule, for example. I mean, I've certainly learned a lot about the resource sector from Rick's interviews and the work he does. As well, when I take a step back and look at the broader macro picture, I learned a lot from, for example, some of Ray Dalio's content out there about, a couple different things, but especially the idea of the long-term debt cycle is something that I've incorporated into my work. And so basically there are major influences that I draw from. And when I was a kid, that one of the biggest sources of learning was Warren Buffett, because it kind of started my investing journey as sort of a value investor type of approach. And I eventually broadened that when I came across like the macro work of Ray Dalio and other content like that. Same thing, Stanley Druckenmiller. I always follow the type of content he's put out. And so, that's the great thing about the internet is actually it's never been easier to kind of learn and kind of, catch up on how different people think about the markets and the type of processes they have.
Yeah, that is interesting. There's several ways I can go from that starting point, but there's one I want to focus on. But I have to say real quick, I think that's a really good point about the education. There's a lot of people out there spending a lot of money on MBAs and all kinds of degrees. And I suppose you get connections from the school, you get introductions and things. But in terms of acquiring knowledge, it seems like a very expensive way to go out about it when there's so much out there, and there are people willing to give and share and help out there. Um, but I want to focus on the engineering aspect. That's really interesting. We had a fellow back in my Casey research days. His name is Bud Conrad, and he too was an engineer who became interested in finance and brought this very methodical, analytical, not just analytical, but I don't want to say algorithmic, but in that sort of broader metaphorical sense of algorithmic versus heuristic, a very methodical, logical, step-by-step approach. And he developed models that seemed to explain a lot, and they were really smart, and they always made perfect sense. but they weren't always right. And so one of the things I've wondered, I've listened to you do interviews before, and I've heard you talk about your models and incorporating, like you mentioned now, some of Ray Dalio's longer term debt cycle modeling into your work. How do you manage the model versus reality? And what reality checks do you use to make sure that you don't guide yourself by a model right off the edge of a cliff because the model says everything's fine?
Exactly. I think that's a really good question. And so one thing I do is I go look. I kind of I love these long-term data sets. And so when I hear about how something works, I say, okay, let me go and test that. Let me see how that's actually done in history. And so I go look at the data, and then from there, you have to watch out between correlations and causations, right? So you have this data set, so you have this idea, first of all, like a narrative, but everyone's got a narrative, and they say, okay, how does the narrative apply to the data? Then if the data looks good, you have a narrative and a data, and then you kind of stress test it. You say, well, why did this happen this way? Could it have happened this way? And so I try to figure out, what is the actual point of causation, and what are kind of the bottlenecks in the system? Where does something break if it doesn't work like this? And that's actually a really big role in, for example, those giant debt cycles, because usually they have their turning points when things are basically stretched to their absolute limits. And you basically say, okay, if this doesn't happen, then this other thing happens, and that's even worse. And so you kind of watch this kind of play out. And so, and I also incorporate, for example, some of the socio-political stuff. It kind of like judging what sort of policies likely to happen. And I often formate things as kind of an if-else equation, where it's like, okay, here's the long-term base case, here's where the breaking points seem to be, but there are a couple decision points ahead that are worth watching. And so, for example, one of the decision points I was watching was, back in 2019 or so, I was okay, when we have an next recession, we're probably going to have a very big fiscal response, just because there's almost nothing else they can do in terms of monetary policy. We're probably going to get a lot of fiscal policy. But then the question was, when March, for example, is playing out, it's like, okay, let's see how this goes. And then so it's kind of like we're watching the decision points play out and saying, here's what I think is going to happen, but we have to actually see it if it's going to materialize, and then adjust if certain things start to happen. And so, I try to incorporate the political realities into any sort of forecast that I do, and always think in terms of probabilities, base cases, kind of understanding points where it could start deviating from the base case, and kind of map it out like that, and then change as we go along. And so, for example, I have, say, a model, but then I'm also actually watching indicators and rate of change terms, economic indicators, and seeing what's actually happening and kind of adjusting the model as new data keep coming in.
Can you give me an example of a time where the data has said, oh, my model was wrong, I better change my course?
Well, an example was, I was actually surprised at the kind of the sharp turn between, say, gold and equities last year. And so for example, saw that gold was likely to roll over because real interest rates were coming off of their bottom. And I was actually surprised, though, at how strong the equity market did during that time period. I kind of thought that they both might have a cooling off period, but equities still kind of went up more than I would have guessed. Same thing for some of the growth stocks, the kind of the unprofitable stay-at-home growth stocks, how they kind of had that really big peak in 2020. And so, a lot of things they looked overvalued, but then they got, in many ways even more overvalued. And so that's one of those things where valuation tells you an idea of what the long-term potential is and kind of what some of the risks are, but it doesn't, of course, tell you what's going to happen in the next 6 months or so. And so generally the where the model kind of usually falls short is often things go say further than expected and longer than expected before they kind of eventually revert to the model. I think another case was that I became a kind of a long-term dollar bear starting in October 2019, and that was because of the repo issue. And so that was an area of my work was really useful because a lot of people were kind of debating on what the repo issue was, and my model is very helpful, kind of guiding through that and kind of figuring out what that was. And so I became more dollar bearish. But then, of course, the pandemic came in the early 2020s. We had the economic shutdown, and of course, because there's so much dollar-denominated debt out there, we had that dollar spike. And so basically, we had these like multi-month deviation from what was otherwise a dollar bearish trend starting to form. And so that whole thing took a couple extra months until we actually saw the down leg eventually happen. And so that's an example where you can have a model, but then a real world event comes and says, okay, your model aside, we're going to push that whole thing back 6 months because it's the real world.
All right. Well, I don't want to go too far down that rabbit hole, but since you mentioned it, repos are The buzz is back on that. Do you have a quick take on the current kerfuffle about the repos?
It's often like a T-bill versus bank reserve issue. And so the issue back in late 2019 was that there were not enough bank reserves compared to how much T-bills were being issued. And so basically they had to essentially revert to deficit monetization. They had to start expanding, the Federal Reserve had to start expanding their balance sheet to buy T-bills. And what we're seeing here in 2021 with the reverse repo situation is banks have been so stuffed full of reserves that they almost have too much reserves, and so they're kind of giving some of that back to the Fed with these daily reverse repo operations. And it's actually somewhat similar to what we saw back in 2014, which is when they were kind of finishing up their last leg of QE3 from that previous cycle, where banks were similarly really stuffed with reserves.
All right. So, do you draw any conclusions from this reverse repo? There are a lot of people saying, oh, this is going to change everything, or is this just tinkering under the hood, as the Fed says?
I think it's another one of those decision points. And so, for example, if you look back at the 2014 period, that was kind of their signal to eventually slow down QE and basically, they flattened out their balance sheet for a number of years. And when that happened, that was a big contributor to the dollar going up compared to the euro, compared to other currencies. That was kind of a tightening event. And that contributed to some of the pain we saw in emerging markets and commodities over the next couple of years. That stronger dollar, because it puts a lot of kind of tightening pressure on, say, emerging markets, which is where actually the majority of global GDP comes from now, GDP growth. And so basically, that's kind of the issue to watch out for, is if they were to say tighten faster than markets expect, you could get that dollar move, and a lot of this big reflationary cycle kind of rolls over for a period of time. The other option is that they're exploring things like increasing the types of standing repos they have, the standing facilities they have. So they basically make some of these facilities more permanent and broad. And so I think they're generally going in that direction, where they're because basically the situation's worse than it was in 2014. They're unlikely to repeat some of those same issues, but it is something to watch for decision points to see. Okay, if say the dollar bear thesis for the next couple of years is like a base case, but I can envision a scenario where that we detour and have like a dollar spike until they have to reverse course again. And so it's basically trying to monitor things in rate of change terms, pay attention to what the Fed's talking about in terms of these facilities, and kind of updating as we go along.
All right. So, monitor. You're not seeing it as something that's already a done deal. There's people that are saying this is a stealth Fed pivot already. You don't buy that?
Well, I think they certainly have an issue there. But for example, when you look back at that 2014 period, they ended up doing reverse repos for like 4 years. The whole kind of 2014 to 2018 period, they were just doing tons of reverse repos. And so they can actually do this for quite a long period of time. They start to run into issues if it gets really big, which we're kind of in the process of testing. And so it is one of the main things that I'm watching right now to see if it leads the Fed to kind of shift anything faster than they expected. But they seem to be going in that more like kind of permanent facility route, which is essentially kind of the Fed taking over more and more of the liquidity markets, and so that's kind of a whole separate discussion. But basically, if you were to see them say, okay, we're gonna stop QE, like tomorrow, well, that changes a lot of how things are currently priced, and so there are kind of risks to watch in terms of how this might affect their monetary policy.
Okay. So that's far enough down that rabbit hole. Thank you for that. Going back to models, and then from there to forecasts. Do you actually make a price forecast? Like my gold forecast for the end of 2021 is X dollars, or do you just sort of like personally? I'm just happy if I get the direction right. And if I get the direction of gold or copper or whatever right, and my stocks go up accordingly, then yay, I'm happy. Whereas if I say gold's going to be 2,500 by the end of the year, the chances of me being right are basically zero. I mean, even if it goes in that direction, I'll still be wrong. I don't like being wrong. So I don't like making that kind of forecast, but I know that the readers love it. They want to hear, the Lobo Tigre or the Lyn Alden forecast. How do you manage that, and what kind of guidance do you give?
Well, like you, I'm mostly about direction, as well as like a kind of a rough magnitude idea. And so, my overall kind of view in practical terms is kind of like to find out which asset classes are likely to do, well compared to other types of asset classes. And so I certainly want to know if gold's going to go up for the next 3 to 5 years versus flat or down for the next 3 to 5 years. But then the actual magnitude of that again comes back to multiple decision points that we don't know in advance. And so I might look at different things like gold has a very strong correlation to negative real interest rates, and so it prefers a period of time where rates are not only negative, real rates, but actually even getting more negative. It really kind of cares about that rate of change rather than just the absolute level. In addition, it has a tight, it basically does well when broad money supply is going up quite a bit. And so basically when you kind of factor those together, you can have a rough idea of the direction that gold should rationally go in, and kind of an order of magnitude idea of how, is it super frothy? Is it super cheap? Is it somewhere in the middle? So I compare gold to, say, other commodities. I compare gold to the broad money supply. I do a bunch of analysis to kind of find out, and basically it's like if you're driving somewhere, you want to have a rough map of kind of where you are and how fast you're going, and if you're just kind of driving in the dark and you're not looking at your speedometer, it's really hard to guess, what's gold going to do, because we're at the end of the day we're kind of forecasting what people are going to pay for a yellow metal. And so of course that's got a tons of variance, tons of sentiment built into that. But when you say, okay, here's how 50 years of data say it works with negative real rates, and in terms of also why it works like that with real rates, and then you say, okay, with money supply going up like probably by this much over the next 3 years as like a base case, here's how, if gold doesn't do this, then it would be basically deviating by this amount. And you can kind of get this like broad direction and general magnitude, but then you keep monitoring that to see how that's going on and what kind of maybe deviations you got from that model.
All right. Well, that uh, sounds like you're singing my song, sister. I appreciate that. I knew there was a voice of reason angle there going. All right. So, and I've heard you talk on other interviews and so on. So I know that your forecast is inflationary. But can you quickly give us like what are the one or two or three main reasons why you don't buy the deflation argument?
So I think it's one of those things where I actually buy most of the deflationary argument. And so I kind of recognize that there is a really big deflationary set of forces. And then there are a big set of inflationary forces. And a lot of it comes down to estimating which one is going to win out. And so the deflationary forces include the massive amount of debt in the system, especially the private debt. And then you look at things like demographics. Then we've had this, 25 plus year period of offshoring, and that's been basically exporting deflation, and exporting inflation, I should say. So it's been a deflationary force. And we've also, the past, depending on which commodity you're looking at, but essentially the past decade, we've been in a commodity abundant regime. And so that's helped keep prices low. We've been kind of in this commodity bear market for a while until, obviously this past year has been different. And so a lot of those forces have been rather deflationary, or at least disinflationary. And then on the other side of that, you have monetary policymakers and fiscal policymakers that are targeting a positive inflation rate, that are kind of always pushing back against those natural deflationary forces and being more inflationary. And so overall, basically the kind of the work I've done shows that fiscal spending, for example, is a lot more inflationary than monetary policy. So when you compare, for example, what the United States has done over the past year compared to what Europe has done over the past year, so the United States has been very fiscal heavy, Europe's been less fiscal heavy, more monetary heavy. You're likely to get more inflation out of a market like the United States compared to a market like Europe. And that's also where I come back to the idea of the long-term debt cycle, where I think a lot of deflationists are kind of looking at, say, the last cycle we went through, which was that great financial crisis, and that basically the model that we're going through now looks quite a bit different than that model. And so that was specifically a private debt bubble that was kind of unfolding. So banks were highly leveraged, and basically we had this kind of multi-year period of at least partial deleveraging. So for example, if you look at household debt as a percentage of GDP in the United States, we actually had a significant deleveraging over the course of the 2010s decade. It's still at high levels compared to, say, like the 60s or 70s, but it was below that higher level. In addition, banks got a lot stronger in their balance sheet because of all the the TARP programs and QE, and this period of deleveraging. A couple banks failed, and so the 2020s. I often make the comparison that the 2010s were a lot like the 1930s, where you had a major private debt bubble, you had a banking crisis, Then you had a period of stagnation and partial deleveraging. Whereas when you got to the 1940s, that's when you had, you had rising populism that whole time. Then you had an external catalyst, which was the war. Then you had tons of fiscal spending, and that was a more inflationary environment. And so we're in this 2020s. We've had rising populism for a decade. We had this external catalyst, and then we have tons of fiscal spending. And so I'm finding that in many ways the 2020s are more like the 1940s, basically rather than another big giant disinflationary cycle. So overall, I'm more on the inflationary side. I also incorporate, for example, looking at the commodity markets. What has capex been like, during this bear market? And so I say, okay, I think the commodity markets are going to look tighter in the 2020s compared to the 2010s. That's an inflationary force. Then we look at globalization. So you can measure it, for example, as global trade as a percentage of global GDP. That's kind of one kind of broad way to measure globalization. And by that metric, it's peaked back in 2008, and it's kind of been in this 10-year or now 13-year kind of sideways consolidation where we haven't unglobalized, we haven't deglobalized, but we haven't continued that rate of globalization. And so now there's more and more kind of political will to either cap it where it is, or even roll it back a little bit and kind of reshore some of the supply chains. We've seen, for example, over the past year and 18 months, how vulnerable a lot of these global supply chains are. And so we basically we sacrificed resiliency for efficiency, and now we're kind of pushing back a little bit more towards resiliency, which undoes some of the, say, the 25-year offshoring deflationary pressures we've had. And so when you kind of combine everything together, I do think the 2020s are likely to have a period where the inflationary argument outweighs the deflationary argument, but it does partially come down to what happens with fiscal spending, which is why we have to kind of keep monitoring that to see.
Six trillion just proposed this morning.
Yeah, but then the
Six
question
trillion.
is,
Why not make it 10? Why not make it 20? 100?
exactly. Yeah, the question though is, does it get through Congress? And so that's kind of the political reality, is they can propose things, but then the question is what can they get through Congress, and how, for example, does the midterm election factor into that? And so that's where we kind of admit we don't know what's actually going to be passed, and we say, okay, we know the general direction that the political will is looking at, but then we say, okay, what actually passes? And so we kind of say, here's the base case, but then let's watch.
Yeah, well, you start with 6 trillion, you negotiate down to 3 trillion. What's a few trillion between friends? Any of these outcomes look inflationary to me. But okay, two questions. Transitory. I mean, clearly, in my view, there's going to be a post-lockdown surge, and yes, that will be transitory. I hate that word. Temporary is just fine by me. Short-lived, even better. But this idea that it all just goes away, or it goes back to how things were before. Why is that wrong? I have my theories, but clearly you don't see inflation as a transitory, just this summer phenomenon, just a base effect phenomenon. So why is that, Lyn?
Mainly because I separate transitory and rate of change terms from absolute terms. And so if we transitory is one of those things that can mean different things to different people. And so when they say inflation is transitory, we have to ask what they mean by that. And so if these price increases were actually transitory, what that would mean in absolute terms would mean that prices go up temporarily due to some supply chain bottleneck, but then they come back down. That would be true transitory inflation. Now, a more likely scenario, in my view, is that these are somewhat transitory in rate of change terms, in that you have a stepwise increase in prices, and then maybe they stop accelerating at that same pace, but then they don't come down to where they were. And you might have some things come down, like, for example, lumber is a specific sawmill bottleneck, and so I think that I've been saying that I think that's going to come down, at least it's going to mean revert, at least directionally back down, maybe not all the way back down, but I don't think it's going to stay at current levels. But basically, you have the situation where if you just had supply chain issues, that would be transitory. But when you have supply chain issues combined with a sharp increase in broad money supply, that money supply stays in the system permanently. And so what you get is these kind of stepwise increases in price levels. And so, for example, if you look at the 1940s, when people think of inflation, they always think of the 70s. But the 40s in many ways are a closer approximation of what's happening here, because the inflation is very, very fiscally driven rather than bank loan driven as it partially was in the 70s. And so, if you look at the 40s, you had these big spikes in inflation, and then it would go away. And then you have another big spike, and then it would go away. But each spike, you didn't have a deflationary force after it that took those prices back down. They just stopped going up. And so each time, if you look at the rate of change of CPI, it looked like these big spikes happening. But if you look at the absolute CPI level, it goes up and then it plateaus and it goes up and it plateaus. And so I'm modeling the 2020s in a sense like that, where I don't think we're just going to keep rising in rate of change terms. I don't think it's going to be like 1 month you have 4% inflation, then 5, then 6, then 7, then 8. And I think it's going to come in these spikes, and that'll partially depend on when they do giant fiscal spending. When we have these bottlenecks, you'll get prices going up. If they get political gridlock, they don't spend for a year or two, you can get the rate of change coming back down, and then they freak out and they do another fiscal bill, and that pushes another spike up. And then the kind of longer term thing that can kind of add somewhat of an inflationary floor to that is if you start to see actual wage pressures pick up.
Yeah.
And so that's kind of the key thing I'm watching as
Yeah,
well.
that's one price that's very hard to have go back down again. I mean, lumber can mean revert, but once you give somebody a raise, you can't take it away from them. They'll quit.
Exactly. Yep. And so that's one of the things I'm watching, and we'll kind of find out more in September, because right now we have these extra unemployment benefits, which are having some pro wage and pressures, because basically employers are forced to compensate more than they might otherwise would, to kind of basically compete with federal unemployment money. But that expires in September, so I'm curious to see how much that sticks around after that period expires.
Right. Okay. See, the other question I had about this, and I have so many more topics I want to get to, so I'm trying to go quickly and hit on the key ones. But do you have a model, or is it part of your modeling on this, for what happens as the world shifts further and further away from the dollar? Like I was really stricken by the headline a few days ago, or maybe a week or two ago, about Russia's foreign reserves shifting for the first time below 50% dollars. And obviously, the Chinese have an interest in moving away from the dollar. We see this sort of mega trend happening in the world. And then on top of that, if you have this sort of division of the internet, you have the unwinding of globalization, there are a lot of factors there that could actually get that exporting of inflation to go into reverse. So if you have an inflationary environment anyway, and then that export goes into reverse, then suddenly you get this kicker effect, or a turbocharger, really sending inflation much higher. Do you model for that, or how could you model for that? Do you think that's likely?
I model for that directionally, and so it's one of those things. It's not like if Russia reduces their dollar reserves by this amount, then it adds, say, 1% to inflation. It's not that specific, but it helps kind of tie things together in terms of the direction that things are going. And so one thing I do is I separate a dollar bear market from a change in the dollar reserve status. And so, for example, if you look back over the past 50 years, we've had 3 dollar bull cycles, kind of $2.50 bear cycles, depending on where we are in this current one. And so, each one of those, the dollar didn't lose reserve status. It just had these big giant fluctuations compared to other currencies. And so a lot of times when the dollar starts to go down, you have all these headlines about dollar reserve status being questioned. And so one thing I try to do is I separate, you can have a 40% dollar bear market versus other currencies without the dollar reserve status being changed. So one is I say, okay, that's one thing, that's a separate variable. And then two, then we can look at longer term structural stuff and say separate from that, or somewhat tied to that, but still somewhat separate to that dollar bull bear cycle, is there something more structurally happening under the surface? And so my view is yes. I mean, basically, the creation of the euro in about over 20 years ago now, that has somewhat reduced the dollar's importance, in terms of its share of global reserves. And then now the next round that we're seeing is that Russia is more interested in selling their oil in euros and then de-dollarizing their reserves. They've been investing primarily in gold and euro-based assets for their reserves. We also see, for example, between Russia and China, they've actually de-dollarized their trade quite a bit, and it's partially local currencies, but it's also the euro took a big chunk of their trade between Russia and China. And we've even seen, for example, Russia and India have a little bit de-dollarized some of their trade as well, which is interesting because India is a closer ally to the United States, and so we see this kind of playing out where we see more and more direction of a global, kind of a multipolar currency system rather than the dollar having such a strong lock on global trade. And so overall, I do think that factors into my longer term dollar bearish thesis. And I think it's almost inevitable to happen because one thing I like to point out is that in the beginning of this, the petrodollar system, so the monetary structure that we've been in since the 70s, at the beginning of that system, the U.S. GDP was like 35% or more of global GDP, and we were by far the biggest commodity importer. And so they had all these deals where almost all commodities are priced in dollars, regardless of who's buying, who's selling. It's all dollar based. But when you get to the point over time where the United States is something like 20% of global GDP, a little bit more, a little bit less, depending if you're looking at purchasing power parity or nominal. But it's gone down in any way you measure it. And then you look at the fact that we're no longer even the biggest commodity importer anymore. We're number two. Basically, the world is kind of shifting more and more towards having a handful of currencies that are able to buy commodities rather than just one currency. And so I do think that factors into basically a dollar bear market thesis in an overall more inflationary environment.
I had not thought of this until you said that just now, but it occurs to me if you have multiple currencies competing for market share in commodities, or just commodities priced in multiple currencies, that's actually a good thing for price discovery, isn't it? I mean, to what
Yeah, it
I
should
don't
be.
know to what degree you subscribe to various manipulation theories and so on, but to whatever degree U.S. based interests are exerting undue influence over prices in these few nexuses that we have in the West, diversification out of that seems like it would have to be good for price discovery.
Well, yeah, I mean the argument there, and sorry if you hear like a leaf blower, like I hear they're doing the lawn care outside, so sorry if there's any sort of interference. But basically, if you look at how pricing works in markets, it's often that marginal price that generally comes in and affects the whole thing. And so when we think of, for example, stock price going down, it's often a very small percentage of the shares that are actually trading hands rapidly, and the majority of shares are just sitting there. And yet those that small percentage moving around quickly can affect the broad price pretty significantly. It affects all the price of the shares, even the ones that are not moving. And so the same thing can happen in commodity markets. And so generally, when you have a dollar bear market, and if you were to have an environment where more currencies can price commodities like say euros or China's currency, that opens up it basically broadens the types of channels that can go around in terms of how these pricing are set. China's even been they experimented first a couple years ago with using different blockchain type stuff to be able to buy commodities. So they did tests with some of the big iron producers, for example, in order to be able to buy commodities outside of the dollar-based system. And then, of course, more recently they moved increasingly towards their own central bank digital currency. And so basically, what they're trying to do is be able to buy commodities in their own currency, so that you don't have a situation where the largest commodity importer is using another country's currency in order to buy all of their commodities. And so I do think over time that should be positive, for the price of many commodities, and kind of opens up some more demand out there.
Okie doke. But one more last macro question, because I want to get to specific commodities and get your take on some things, other assets. Try to rip through those quickly. But will good news ever be good news again for markets? Or when will bad news actually be bad enough that markets won't go up on bad news? We have this, or another way of asking this is there any way for the U.S. economy to ever not be a Fed-driven economy? How do we get out of this mess? Is that possible?
Well, if you look again at the concept of the long-term debt cycle, usually this sort of, when there's this much debt in the system, when there's this many bottlenecks in the system, usually it requires a very big phase change, which is generally, at the core of that is a currency devaluation before things essentially get reset. Because when they build up that much debt, when they use artificially low interest rates, they use all sorts of programs to basically get debt this high to begin with. They never could have gotten this high without some of the manipulations that have occurred. So when they get that this high, it's almost impossible to unravel it without crashing the economy. And so instead, they turn more towards currency devaluation, which is what we've seen in 2020 and 2021, for example. And so essentially, until you have probably a significant currency devaluation and kind of a somewhat of a reset of the situation, you're unlikely to untether markets from these big kind of central forces. And so that's actually one of the big challenges. And so, but if you look at individual segments of the market, there are still areas that are kind of undergoing price discovery a little bit more. And so, for example, if you look at value stocks or some of the commodity stocks, they were more sensitive to good news and bad news in the way that would make sense. And so, when you had kind of say vaccine announcements or any sort of positive news on the virus front or positive news on fiscal stimulus or things like that, some of those more value-oriented things did better. Whereas growth, because growth stocks kind of became like a bond proxy, there are these big expensive equities that can kind of, they're somewhat detached from the cyclical gyrations of the economy, and so people pile those into those when they want to feel safe. And so a lot of times those do actually pretty well in a more kind of problematic environment. And so we've had these kind of growth to value rotations. So I would say that if you look at the market underneath the surface of the index, it kind of made more sense in that, in the sense that where the cyclical things have responded to good economic news more. And so, but I think that for the broad indices to start following good news, it's going to be very tough until we actually get past some of these giant debt problems that we have, and that's not going to be, smooth.
So is that a Lyn Alden forecast? There is a reset coming?
So I think a reset can take multiple shapes, and so I think one of the models that I use again the most is the 1940s, because you had an environment where you had huge inflationary spikes, and unlike the 70s, they still held interest rates at zero. And because that, the difference between the 70s and the 40s was that in the 70s, you actually had pretty low private and federal debt as a percentage of GDP. And so you had policymakers able to raise rates to try to quell inflation. Whereas in the 1940s, you had federal debt as a percentage of GDP over 100%. And so, when they were having these big fiscal expenditures for the war, when you had inflation going up to, year-over-year terms, it got as high as like 19 to 20% at some points. Even though the average for the decade was something like 6%, you had these big spikes in inflation. And the Federal Reserve just said, no, we're just going to hold rates zero. We're going to support the war effort. We're even going to cap long end yields if needed. And so I kind of viewing that environment as that's one way where you can devalue something over time. And so if you look back at that 30s and 40s period, you had kind of the one-time reset with the gold revaluation in the 30s, but that wasn't the end of it. That was kind of the first stage of it. And then the later part of it was the 40s, where you had just inflation running hot, interest rates held at zero. And so whether you were holding the short end of the curve or the long end of the curve or the treasury market or many other types of debt instruments, you were losing out on an inflation adjusted basis. And so that's kind of my base case, is that however this works out, I expect that most types of fixed income instruments are likely to yield below the prevailing inflation rate for the better part of this decade. And then if you could punctuate that with more harsh kind of stepwise changes, but that'd be kind of my at least minimum case.
All right, thank you for that. So let's try to get to some specific commodities and assets here. I know you're bullish on gold. To try to be useful to the audience, let's rephrase that rather than just a broad outlook. Is gold and gold-related equities, is that a buy right now, or having screen back up to 1900? Is it time for a breather here, or what are you doing with your money in this space right now?
So I wouldn't be surprised to see a breather here, but because I invest with a multi-year term in view, which is a tax-efficient way to invest, I'm not kind of trying to time each little up leg and down leg. And so I've been bullish on gold and gold miners since late 2018. And so even though there have been times where that stagnated or
The Powell
dragged down,
pivot.
pretty much, yeah. And actually, I turned bullish slightly before then, but and so it was around September, October where I started to get more interested in these gold and gold equities, mainly because I was following what real interest rates were doing, and the Powell pivot obviously was a big part of that. And so basically, you've had this period where we've had real interest rates when if you look at say the 10-year Treasury minus 10-year break-even rates, that was about 1% back in 2018. So you're basically getting 1% more yield than inflation. And then over the course from say 2018 to 2020, that went down to negative 1%. And so basically nominal yields fell faster than inflation fell. And so you got down to a little bit worse than -1%. And we started to see a bounce since mid 2020 where nominal yields started to come back up a little bit. And even though real yields stayed negative, they were just less negative than before. And then what we see now is that as these base effects are kicking in and as some of this fiscal policy is really starting to kick in, we're getting this more inflationary period and bond yields are not keeping up. And so real yields have kind of rolled back over. And it's my overall base case that gold is likely to continue to do well with, say, a 3 to 5 year period, because I expect, the two main variables, I think we're going to have significant broad money supply growth. And I also think that rates are going to spend the majority of that time, real rates are going to be mostly negative for that time. And probably I think we're going to see lower than the peak we saw last year. I think we're probably going to see less than -1%, and that should be good for gold and gold equities. Another thing I point out is that even compared to gold equities are fairly cheap, and so we've actually, gold equities in general are producing more free cash flow than they have in a very long time, and their balance sheets have arguably never been better, at least the ones I'm looking at, and a lot of kind of in a broad way of speaking. And so if you look at, for example, I use Barrick as an example. I mean, back in 2012, I mean, gold was as high as it was. The company was managing not to make, much free cash flow. They piled up tons of debt during the course of that next following bear market. But ever since, 2015, 2016, they've been rationing down their debt levels, building up cash levels, and they're getting more and more free cash flow positive. And that's a trend you see in multiple different types of mining companies out there. And so in terms of that overall space, as long as gold kind of stays roughly where it is or goes up, those gold miners are, in my view, pretty well positioned, even at current gold prices.
All right, and I certainly get the longer term view, but you didn't actually answer my question. If you had money to invest today, would you buy gold stocks now, or would you kind of? I mean, it's not a sin to say, oh well, I might wait a minute. That's not necessarily market timing, a little bit, but would you invest today or not?
I would, yes, and actually I am. So the way, a lot of the ways I do it is I often dollar cost average into portfolios, and so it takes the emphasis a little bit less on specific events, and more on the kind of that process of continually adding funds to whatever is offering a good risk adjusted forward return. And so I am putting money into gold equities as well as into gold as well. And as far as specific pivots, I mean, for example, back in March, I kind of highlighted that in my service more. I kind of, said it looks like we're getting kind of a bottom in gold here. It looks like real rates are rolling over. So I kind of made that more specific timing indicator, saying I'm not sure this is the bottom, but it's looking like better evidence that it is the bottom. And I kind of followed that up. And so now we've had a significant run. I wouldn't be surprised to see a breather. So I'm kind of pounding the table on it a little bit less than I was maybe 2 months
Sure.
ago. But that, if I back up and say the grand scheme of things, I'm still happily buying, gold and gold equities here as part of my broader portfolio.
Thanks for that. That actually reminds me, you haven't really said anything about technical analysis. Do you look at that at all? I mean, that March bottom was a famous double bottom. A lot of people were doing a lot of arm waving, like, oh, double bottom in for gold, it's time to buy. But that might have been a shoulder, so I never know what to make of those. Do you look at that at all?
Uh, Basically just a small amount. And so I like to say that I'm 95% fundamental, 5% technical. And so, I prefer not to buy something that's just going straight down, right? I like to see some sort of attempted rolling over there. And so, for example, I look at everything, I find out what's cheap, I find out what's fundamentally good, and then I say, okay, is it showing actually some sort of price confirmation? And so I do look at basic overbought, oversold levels. I look at things that have formed some sort of double bottom. I look at basically, that the market is starting to agree rather than, not figuring it out yet. And so I think that's kind of the sweet spot of saying you have the fundamental case and to say, is price starting to confirm a little bit? And so again, there's a dollar cost averaging view where you kind of ignore those fluctuations. But then if you are trying to provide that more specific, kind of turning point, which I try to do as well, that's when I incorporate a little bit of technical analysis and say, okay, the fundamental case is good, but then in addition, we're starting to get actually some price confirmation or some technical confirmation.
Personally, I'd rather have a sense that I'm looking at the bottom in the rearview mirror than that I'm trying to catch a falling knife. But okay, so moving on from gold to silver, do you see them as different at all or interchangeable monetary metals? I mean, we note, for example, that there's all this kerfuffle about Basel III, which includes gold but not silver.
So essentially, I mean, silver is like a hybrid metal, and so it includes like a monetary premium, but it's also an industrial metal, and so it has a lower stock to flow ratio than gold, but higher than something like copper or oil, and it's more volatile, obviously, and as you pointed out, it has different regulations surrounding how it counts in capital structures and things like that, and so overall, I view them as somewhat different. In addition, if you have a more you know which one outperforms generally depends on having a more disinflationary environment or a more inflationary environment. And so, for example, from 2018 to 2020, gold was a big outperformer of silver because that was a more disinflationary environment. So real yields were going down because both inflation and nominal treasury yields were going down, and it just so happens that the treasury yields were going down faster. And so that was a very attractive environment for gold. Whereas silver is a more inflationary metal, partially because of the industrial component, partially because of the risk on, higher volatility mindset of it. And so when you have that more inflationary period, generally silver is more likely to do better. And so my overall case for a while is that I like both. In a bull market I'd expect silver to probably outperform, but not necessarily with high conviction. Like my base case would be I'd be I'd be a little bit surprised to see silver not outperform gold, but that on a risk-adjusted basis, gold it has I think a more important role in a portfolio than silver. But I like to split it up and I own more gold than silver, but that I do incorporate both into a portfolio.
All right. So, with your broadly inflationary outlook, I would assume that you're broadly bullish on most industrial metals. Do you have any favorites that you would highlight?
So those change over time. And so, for example, back in the summer 2020, I was analyzing copper stocks and recommending copper stocks because that's a really good story for the next 10 years. And they were just super cheap during that period. But because we've had such a strong rise in copper, I've been a little bit more hesitant at these higher prices. I was somewhat of expecting a little bit of a consolidation or a pullback. And so far, it's been mainly consolidation. We haven't really seen a significant price correction in these copper equities, and so that's a space that I have a long-term optimism on. I get a little concerned when something becomes consensus or it went up very quickly, very significantly and very fast, and so that kind of rotation happens over time. And so in mid 2020, it was kind of like gold stocks. I was kind of like, I don't see a catalyst anymore, but copper stocks are great. And then in March 2020, it's like copper stocks, I don't know, but gold stocks are starting to look a little bit better here. And so I kind of play those kind of relative appeals over time.
Sorry, you
Uh,
meant March 2021.
yeah, March 2021, this year. And so basically, we kind of saw that rotation happening. And then another thing I've been really interested on is the energy market. And so, for example, and you can kind of separate that into the producers versus the transporters. And one thing I like about the transporters is that they're not that price sensitive, but they still in many ways are still pretty cheap even at current levels. And so they haven't had some of the big rises that some of the other commodity markets had. And then the producers, I also like to look at some of the low cost producers, including some of the ones in Russia, as well as some of the higher quality ones in Canada or Europe and places like that. And so overall, I am pretty bullish on energy markets more so than I was in 2020. And so I think that oil story still has a pretty big runway to go because that hasn't really gone up as quickly as some of these other commodity prices have. We've seen a lot of outperformance in the commodity X energy space, whereas energies, a lot of these equities are still kind of trading at where they were pre-pandemic, if that. And oils, nothing's really super exciting in the oil market yet. You haven't seen oil do the lumber move, or it hasn't touched all-time highs like gold has. And so basically, because the energy market is still kind of a longer-term process playing out, there's still a period of oversupply in some sense. So if you look at OPEC spare capacity, there's still kind of plenty of near-term supply. And so that's been a kind of a less consensus story. And so it's something that I think has a kind of a longer runway ahead in terms of maybe surprising to the
Do you
upside.
lump oil and gas together, or are you more specifically looking at oil?
So I look more at oil in terms of pricing. Natural gas is something that I kind of leave more towards niche experts, just because it's a kind of a more specific market with more seasonal fluctuations and things like that. But I do like oil companies that have a significant natural gas component. I think that Natural gas is a little bit more future-proof than oil in some ways. I also, for example, when I look at, say, pipeline companies, for example, I like ones that produce that they transport natural gas, they transport natural gas liquids, they transport petrochemicals. I do like to diversify the types of petro-based products that I'm getting exposure to with my different types of investments in the space.
I, that reminds me, with the MLPs in particular, I remember, gosh, must have been 10 years ago. I don't remember specifically when. It was after the crash, and commodities had rebounded, oil had rebounded. We were worried about how sustainable the high oil prices were, and then the argument was, well, we can get into the transportation companies because they get paid whatever the price of oil is. Unless people stop shipping oil, which isn't going to happen, they'll be fine. That was the logic, but the reality was that when oil did go back into reverse in a big way, the MLPs got hammered just the same. So is that really I mean, not trying to put you on the spot, but has that worked out for you as a defense? It was a while ago, but I remember that did not work out well for me and my readers back in the day.
So one thing I think it's a really good question. One thing is that we're seeing some of a change in the industry. And so one is I certainly have a high quality component for MLPs I buy. And so, for example, there are ones that got through this whole process without a distribution cut, right? So some of them have done very, very well fundamentally, even though they got cheaper. And so it comes down to valuation. So MLPs in general were pretty expensive in that 2014 period, but based on most valuation metrics, whereas now they're a lot cheaper. But then two, a big change we've seen in the industry is it's become more self-financing. And so the big problem that those MLPs had back then was that they were almost like relying on Ponzi finance, in the sense they were reliant on constant external capital, both in debt markets and in issuing new units. And so Kinder Morgan was a good example where their business was relatively defensive. But it just wasn't defensive compared to how much they were reliant on issuing equity at high prices to keep kind of funding that, and how much leverage they had. And so some of the smarter ones they kind of saw the writing on the wall ahead of time, and they started shifting more and more towards a self-financing model where they pay out lower distribution payout ratios, and they're able to self-fund more of their own operations. And so when the blow up happened, because they were less leveraged, because they were less reliant on issuing new equity, they were buffered from that downside. And so they said, okay, our volumes went down a little bit, but we're fine. We're still able to pay our distributions and keep raising our distributions. Whereas those more leveraged ones are the ones that blew up more spectacularly. And
You bring up, sorry, let me jump in there. It's a really interesting point. You look at these market events like March 2020, and it's a disaster. Bad things happen, but they're a source of opportunity, because you see who the survivors are. Not just survivors, you see who really are the better businesses, the people that either have the moat or just have a really solid business. And then afterwards, you have an opportunity to act with that knowledge in hand. You don't have to guess which are the better companies. You know which are the better companies. So I'd see those things as going forward as a gift, really, really useful information coming through those kind of events. But anyway, back to energy. You said energy, but then you're really more oil than gas. Do you buy that copper is the new oil? Is copper an energy metal, an energy commodity now, or is it something else?
well, I mean, it's an energy transmission metal. It's less about production and more about transmitting it. And so we need, for example, large grid updates if we're going to have as many electric vehicles
Right,
on
but
the
you like
road as
pipelines for oil, so maybe.
exactly. Yeah, and that's why I've been bullish on copper stocks until more recently I've been a little bit more hesitant on some of them. And so I do think that over the course of the 2020s decade, probably copper is going to do pretty well, because it's important for so many things, not only inside electric vehicles, but then just mainly the huge grid updates that are needed in order to have more of our energy flowing through the electrical grid, rather than maybe less through some of these pipelines over time, or at least the balance kind of shifts more and more towards the grid a little bit. And so people often think that electricity is kind of an energy source, whereas electricity is an energy transmission. It still needs to be produced by something, whether it's natural gas, coal, nuclear, solar, wind, whatever the case may be. it still has to be produced before it's transmitted. And so I view copper as a very important commodity for the 2020s decade, but just less so in terms of, say, energy production. Kind of similar thing, for how I view semiconductors, right? So semiconductors are increasingly a strategically important commodity-like asset, where if you have a foundry that can produce semiconductors, it's obviously less of a commodity than, say, something like copper, because there's different types of semiconductors and they're very specific. But the point is, we're in an environment where, strategically, the semiconductor foundries are virtually as important as the big oil producing nations, for example.
Yes, I wrote some time ago about chips as a raw material, but that's not my field of expertise. So I really couldn't. I mean, metaphorically, it seemed like, okay, maybe I'm not the one to judge the right IT company, but I can see chips as a raw material, as a resource. But I never found a way to implement that. But let's focus on the energy a little bit more here. Other energy metals, are you bullish on copper, lithium, or other ones there, or too niche for you?
So some of them are too
Sorry,
niche that I
sorry, I
don't.
meant nickel, lithium, cobalt. We already talked copper.
Yeah, so I am bullish on nickel. I am bullish on uranium. Sometimes I get questions about something like tin, and it's one of those things where conceptually I'm bullish on it, but it's just something that I haven't, for example, done a ton of homework on. I don't have specific investments in mind. I don't have a specific price model in mind. Whereas something like oil, copper, nickel, uranium, gold, silver, those are markets that I'm able to follow more closely. And so, nickel again is kind of like copper, where it's likely to be very, very important for the 2020s decade. Not only is it used for stainless steel, but it also plays a very large component in most battery applications. And so I am bullish on the use of nickel overall, and in general on the price direction of nickel. And so I think that kind of goes along with copper, in the sense that it's a 21st century metal that you probably want to have exposure to.
Are you concerned at all about the sort of debottlenecking in the Philippines and Indonesia, where that really put a constraint on nickel specifically for a while, and it seems to be unwinding now?
So that certainly plays a role in kind of the intermediate term. But I think overall, if this is directionally plays out
Yes.
anything like what some of the electrical bulls think is going to happen in the 2020s, I think we're really going to need pretty much all that nickel.
All right, fair enough. Given your time frame, that is a perfectly logical answer. I was going to ask you about uranium. You brought that up too. Do you see that as, like oil, just another energy commodity, or is it different in any way?
Well, it's an energy commodity in the sense that it's primarily used now is in producing grid energy. But of course, it's different from oil in the sense that uranium is a very small percentage of the input cost for nuclear energy. Mostly, it's the capex cost, and then a much smaller component is the uranium addition that's being put in. And it's also a much weirder market than oil, and so you have all those long-term contracts rather than the spot pricing that mostly takes place. And so it is an energy commodity. It just operates very differently on its own schedule. It's not necessarily a big cyclical use like oil along with copper are kind of very good cyclical commodities, in the sense that whenever you have an economic boom or a slowdown, you have these very specific waves of like commodity and copper usage fluctuating in rate of change terms, whereas uranium is a more kind of steady state type of energy source, and so you don't generally see those economic fluctuations like you do with those other ones. And so it is an energy commodity, but it's just a very different one. And it has, very different supply demand characteristics. And so ever since late 2020, I've been pretty bullish on uranium. And because I'm not a niche expert that's going around and kind of picking individual small, I can't say this small uranium player is better than this other small uranium player. My overall exposure is to have exposure to the price itself, as well as exposure to the broader set of companies, and especially the larger companies, as basically someone who's from a macro perspective bullish on it, rather than a niche expert.
That actually segues into a different kind of question I was going to ask you. I'm not going to ask you to give away any stock picks. I don't like doing that myself. I think it's unfair to clients who pay for that information to go and give it away. But company types, like you just mentioned in this particular space, it makes sense. That you like the larger players rather than the smaller ones. In general, you're a macro analyst. You're a big picture thinker. Nothing that you've said, and I don't want to judge it, but just nothing you've said so far suggests that you have experience in actually geology and mine engineering and that sort of thing. So broadly speaking, do you generally favor bigger companies that fit with your macro theme, or do you ever dig down into the juniors and that type of company, or do you look at exploration at all?
So in general, I do prefer the larger entities because I don't have that geological experience to have kind of an edge to say I think this this mine here is probably going to surprise the upside, whereas the other one's going to surprise the downside. And so I generally focus on the larger space to make sure I capture most of the move that I expect to happen from a more macro perspective. I do diversify down into mid caps for a lot of the metals that I invest in, especially gold and silver. And for there, I focus primarily on capital structure, management quality, things that I can analyze from a financial perspective, as well as seeing what other niche experts are saying on it, and basically get an idea there. But for me, those mid caps might be a smaller percentage of my portfolio, so that if any one of them ends up being a poor investment, it doesn't really affect the overall portfolio direction. And so, my way is kind of, say in the gold market, I'm incorporating royalty companies, I'm incorporating large cap miners as well as mid cap miners, and I kind of leave the exploration companies to others. And then, same thing for copper, uranium. I prefer these, where the metal's there, it's known, and it's more about what the price direction is going to be. And then I look at, for example, what are their costs of production? Are they levered or unlevered? And so I kind of judge what I want to be in terms of how kind of overall conservative it is and how good management is.
Okay, very good. All right, we're going on an hour here, and I don't want to presume too much on your time. I appreciate that you spent so much with us, but can I ask you real quick, platinum group metals, any interest there?
So I've been bullish on platinum. That's I don't follow platinum as closely, but I have been bullish on platinum, mainly in terms of I focus on that market a lot less than say gold. But when platinum gets unusually cheap versus gold, and I start to see some sort of rotation up, I do like it as a diversifier. But for me, it's somewhat more speculative in the sense that I don't have metrics to track it quite as close as I do with gold. And so it's more like a speculation where I'll put a small allocation in where I say, okay, platinum's unusually cheap. It's turning up. It's obviously a very rare metal. There's specific bottlenecks that can happen there. And also like the platinum versus palladium kind of industry kind of shifts back and forth between what metals are being more used. And so when it's deeply out of favor and turning up, I am pretty bullish on platinum. And I do still currently have platinum in my portfolios.
All right. Any other favorites that you would highlight, commodity wise?
I think that pretty much covers it. I mean, basically the broad big ones are the ones that I primarily focus on. I also don't do a lot in the agricultural space, just because that's a very different kind of analysis. Those have faster cycles where you can get more supply online. I do have some exposure to the fertilizer companies as a diversifier. And so, my overall kind of commodity approach is pretty broad here because it's really about kind of a broad reflation, inflation cycle after a decade of commodities doing quite poorly. And so, I tweak that based on these rate of change analysis. And so, for example, a couple years ago, I was more bullish on gold, but then as gold outperformed a lot of these other commodities, that's when I got more into some of these other more industrial or more cyclical commodities. But I try to stick where possible to the ones that I actually know something about.
All right. And I've got to ask you about cryptos a bit, just because it's so rare to find somebody who seems rational on the subject. On either side, I might say. On either side, there's just so much hate going back and forth that I think is very silly and counterproductive.
I agree.
I agree with you that it should be both. And which one's better? I don't know. Let the market decide. But the question is, if I'm a speculator and I'm looking what's just happened, is Bitcoin a buy now? Would you put more money into Bitcoin now, or can it still fall off another cliff? Our conversation earlier about not wanting to catch the falling knife. How do you see Bitcoin now?
So I am pretty bullish now. I'm less bullish than I was in say mid 2020. So back then it was a very asymmetrical outcome. And so, as we got this big price increase, started to say that, it's less asymmetric, even though I've remained bullish. Then we did get this pretty significant correction. And that actually increases my bullishness compared to a couple months ago because we've let out some of the euphoria. But it's still somewhat uncertain price structure at this current time. And so the underlying network effects, in my view, are still pretty strong for Bitcoin. And so we see, for example, more moves from some of the asset managers like NYDIG are moving to incorporate Bitcoin into banks. For example, we're probably by 2022 you'll be able to buy Bitcoin within an existing bank account, similar to how we've seen that integration happen in PayPal. And also, I'm really excited about some of the development we're seeing on the Lightning Network, which is the second layer of Bitcoin that allows for more rapid payments and some of the more kind of payment-based applications. And so overall, I'm still fundamentally bullish on the space, but we do have kind of uncertain price structure at this time. And so my overall way to play it is I kind of like how with gold, I separate kind of an insurance position from a tactical position. And so, I think, for example, the gold market, it's good to have, say, precious metal, but then also you can make a more tactical portfolio bet on, say, the miners or gold ETF, whatever the case may be, that's more kind of time sensitive. And so one thing I do is that I have, say, cold storage Bitcoin, which I don't really plan on selling for a number of years. And it's just kind of like I'm going to let that play out for better or worse. But then I can use something like the Grayscale Bitcoin Trust or more liquid Bitcoin to make a tactical kind of bet. And so one thing I've done is that I entered the position in early 2020, and then, for example, as we got Grayscale Bitcoin Trust going up, 3x and then 5x, I did trim my position to some extent to basically remove my cost basis from that position, also remove a little bit more than the cost basis. And so as we got a correction, I've not bought more, but I've had continued to hold the rest of that position with a kind of a plan of, say, 1 to 3 years that I still plan to hold that position. So I am still bullish, and I often phrase it as I think it's ideal to have a non-zero Bitcoin position. And that can mean different things to different people. That can mean 1%, that can mean 0.5%. For some hardcore people, that can mean double-digit percentages. But I would say, for example, this correction I think opens up a good case that if someone was on the fence, that having a non-zero Bitcoin position is probably suitable at this time.
Right. So
But
if you were brand new to Bitcoin right now, at around plus or minus 40,000, would that be a buy? Like brand new, you had zero already allocation. Would you be comfortable buying at 40,000?
I would, yes. But again, as a percentage, like I'm not one of those people that think people should go all in on Bitcoin. But I do think that the current price, as a small percentage of a portfolio, I think it is a good time to go from a non-zero position to, I go from a zero position to a non-zero position.
Okay. And so again, not the big, so there's Bitcoin maximalism and there's Bitcoin maximalism. There's people who just love Bitcoin, but there's also the more specific argument that's sort of like the one ring of power. At the end of the day, Bitcoin becomes the only one. It consumes them all. Or like Highlander, right? In the end, there can only be one. Do you buy that?
So I think there's partially, and so basically what it comes down to, one of the biggest risk in the whole cryptocurrency space is the concept of dilution. And so, bringing it back to precious metals, there's only a handful of precious metals, and so they're not really competing with each other too much. Each one is chemically unique. Each one is rare in its own way and can't be substituted too much with the others. And so, overall, that basically makes each one unique. With cryptocurrencies, what you're essentially relying on is the network effect of that protocol. Basically, that protocol has to not just be one of the thousands out there. It has to be kind of the Wikipedia of websites, for example. It has to have the widest network effect. And so, what Bitcoin's achieved is because it was the first one, because it was not pre-mined, because it was just really well designed from the beginning. That one had this kind of big head start in terms of adoption, network effects. It's arguably the most decentralized in the sense that anyone can run a full node pretty easily. You can verify the whole money supply, and so overall, Bitcoin has a lot of advantages. We do see the second network that has a significant network effect is Ethereum, but besides those two, most of the other ones is kind of this long tail of other assets. And so over my base case that I do think Bitcoin is going to retain a very large percentage of the overall cryptocurrency space. But that I am bullish on, for example, stable coins. So when I look at the broad space and I'm say measuring Bitcoin's dominance as a percentage of total cryptocurrency market cap, I usually remove stable coins because that's kind of a fiat currencies going into the market. And so I say, okay, I'm putting stable coins in another bucket. I am bullish on the existence of stable coins, which are generally not running on Bitcoin like they used to. They're running on other types of protocols. I do think Ethereum is probably here to stay for quite a while. I think it still remains to be seen how that's going to defend against other utility protocols that are kind of coming along and basically cheaper than Ethereum now. So you see, for example, some of the applications that were on Ethereum the transaction fees got so expensive that they started spilling onto other protocols. And so I don't really have a view too much on
Actually,
which.
actually, let me jump in there, Lyn, just real quick. Actually, the use case for Ethereum and the applications based on was actually why when I did put some play money into cryptos, it was Ethereum and not Bitcoin, and I tripled my money, so I'm happy. But I can't actually think of any of these use cases that have actually materialized. Like all the idea was that Ethereum was going to be more useful and tied in with smart contracts was going to enable all these wonderful applications. I can't actually think of one. Is there one? Like, what can I look at? Where's a website I can go that has this wonderful business or engine that was based on Ethereum? Does that exist somewhere?
Mainly in DeFi markets. And so one of the concerns I've had with Ethereum, it is rather circular. And so Ethereum is highly used, for example, for decentralized liquidity protocols, where you can borrow or lend, basically using Ethereum and basically these other tokens that run on Ethereum without a centralized third party. And so, for example, you can trade tokens with someone without going to Coinbase. You can do it in decentralized finance. You can even borrow against your position and leverage your position using some of the underlying technology of Ethereum. The big problem is that it's quite circular in the sense that you're using Ethereum to basically bet on which other tokens are going to outperform other tokens, and so you kind of have this big speculative kind of circular use case. Now that could eventually broaden and include, say, more stocks and bonds that are tokenized and trade on these decentralized exchanges. That remains to be seen how big of a market that might become, and so I do think it's a space worth watching. In addition, I think stable coins are a very useful application of some of these utility protocols, where what you essentially have is a more liquid and kind of better payment rails in some ways. If you see kind of businesses that get more crypto native, they joke that it's like an act of violence to send them like a non stable coin wire. They're like, why do I like basically the legacy banking system is so slow to them compared to how fast stable coins can move around. And so I think that's a good use case of some of those protocols. But with Bitcoin, the reason I like Bitcoin is that it's somewhat more kind of self-referential in the sense that I view Bitcoin as arguably its own use case, in the sense that it is, for lack of a better description, it's the digital gold of the crypto space. And so it's the kind of the hardest, the money supply, the monetary policy that can't really change, right? So it's the hardest kind of policy to change. Basically, you need buy-in from both the node network and hash power in order to make major changes to the protocol. And so overall, I view Bitcoin as kind of the one that I have the highest conviction on doing well in the long term. I cover Ethereum to an extent, and I often say that when Bitcoin does well, I expect Ethereum to do even better. But I have kind of longer term questions about Ethereum that, in my view, it's basically from an engineering perspective, I have more concerns about its level of decentralization compared to what I have about Bitcoin. And so my higher
What about the
conviction.
crossovers, Lyn? Like Load One or Glint that try to combine the precious metals with the crypto space. So, does that make sense to you, or not a fan?
I think to some extent, I mean, there's one called, for example, Paxos Gold, where you basically have a stable coin, but instead of being pegged to a dollar, it's pegged to gold. And so they have allocated gold in their vaults, and then they have these tokens, and people can trade around those tokens, and it's kind of like a gold ETF, except it's arguably a better vehicle for that. And so there are kind of blend over periods, or applications where you can use both. And for example, there's that company BlockFi, where there's Bitcoin, Ethereum, and stablecoin lending and depositing. And one of the things that they do is Paxos Gold. So someone can literally have a Paxos Gold token, deposit at BlockFi. Now they take on counterparty risk, but then they can earn a kind of a moderate yield on their gold. So it's an interesting application there. And so I think there are ways to blend the two worlds that we're seeing play out a little bit.
All right. Well, I've asked you dozens of questions here, so let me actually turn it around for a moment and say, is there anything on your mind right now that a new Lyn Alden insight? You're looking at the markets right now, and you've got this idea. What's important? What's new? What would you like to tell the audience?
I think what's new. I think it's going to be really important to keep in mind that things don't happen in a straight line. And so even though I'm structurally inflationary, I am looking for later this year probably a rollover in some of these rate of change numbers. And so, for example, I think we're going to see inflation go up. We saw the April numbers reported in May. I think, when we see the May numbers reported in June, they're going to be higher in year-over-year terms. And then I think as you get to the June numbers, that might or may not be higher. But then as you get to August and July, I think those numbers might actually be lower
Right.
than some of
The
those
base
those
effects
May.
go into reverse. It'll be, well, who knows what'll happen, but it'd be really interesting if when the base effects go into reverse, suddenly things don't look as transitory as we were promised. Then what do they do?
Exactly. And so I think there is turbulence ahead, and I think that it's one of those things where inflationists and deflationists are going to be kind of like basically doing victory laps, both kind of prematurely. Where right now the inflationists are ahead, and I think there's going to be months in the future where inflation's rolling over a little bit, and then deflationists are kind of saying, no, look, it was transitory, and then it's going to roll back up, and we're going to then get inflationists back on top. And so overall, my expectation is to have this be a rather inflationary decade, but I think that people can get really caught up at the top, and once inflation's on all the headlines, I think that's when you're actually looking potentially for a couple quarters where that cools off a little bit, and some of those trades unwind a little bit, and that's where I would actually use that opportunity to kind of get into more of those inflationary assets. And so I think my overall view here is that it's going to be inflationary probably, but just not in a straight line. And I think investors can kind of use that to their advantage if they monitor things in rate of change terms, both in terms of base effects, but also in terms of, for example, we've had 3 rounds of stimulus checks, and there's kind of no more coming for the next several months. And so some of those effects start to wear off, and then the market just starts saying, well, what's next? What's next? And if the answer is nothing, then it rolls over a little bit until whatever comes next. And so I think that there are going to be opportunities to kind of re-enter some of these positions most likely, and that that there is likely to be turbulence ahead, even for some of these things that I'm bullish on. I think we could see sizable corrections in.
Monitor rates of change, or as my friend Doug Casey says, make volatility your friend. All
Exactly.
sounds good. All right. Well, final word, Lyn. Where can our audience find out more? LynAlden.com. What do you recommend people start at? How do they connect? How do they find out more about what you do, and how you can be of service to them?
So they can check out my public articles there, and then also I have a free newsletter they can sign up to, and that comes out every 6 weeks. And that's actually a long form research piece that comes out every 6 weeks. So it's not one of those like spam newsletters. It's actually it's something it's a serious piece of content that I put out. And so that's pretty popular. That's kind of how people I think get caught up in the type of work I do. And then I'm also active on Twitter at Lyn Alden Contact.
All right. Well, thank you so much for your time. You've been very generous. I appreciate it. And let's stay in touch.
Yep, happy to. Thank you.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.